Topic 5 Methods and Models in the CAIA Level 2 curriculum focuses on quantitative techniques, financial modeling, and analytical frameworks used in alternative investment analysis and portfolio management. The curriculum introduces different categories of models, including normative versus positive models, theoretical versus empirical approaches, and cross-sectional versus time series frameworks. Candidates learn the importance of methodology in constructing reliable investment models and how exogenous and endogenous variables influence financial outcomes. The topic emphasizes that models are simplifications of reality designed to support decision-making rather than perfect predictors of market behavior. Understanding model assumptions, strengths, and limitations is therefore essential for effective investment analysis and risk management. A major section of Topic 5 examines fixed income and credit risk models. Candidates study equilibrium term structure models such as Vosicek and Cox-Ingersoll-Ross, as well as arbitrage-free frameworks including the Ho-Lee and Black-Dermontoy models. The curriculum explains how these models are used to value bonds, interest rate derivatives, and structured products. Credit risk modeling is explored through structural models, reduced form models, and empirical approaches. Candidates analyze the Merton model, KMV framework, default intensity models, and Altman Z-score methodology to evaluate probability of default, recovery rates, credit spreads, and expected losses. These models provide essential tools for assessing creditworthiness and pricing risky securities. The curriculum also emphasizes binomial tree models and risk-neutral valuation techniques used in pricing derivatives and convertible securities. Candidates learn how to construct one-period and multi-period binomial trees, apply risk-neutral probabilities, and value callable bonds and convertible securities through backward induction. The material demonstrates how tree-based frameworks model uncertainty, interest rate changes, and default risk within structured products. Candidates also explore valuation adjustments involving compounded returns and volatility calibration. These quantitative approaches are particularly relevant in alternative investments where embedded options, leverage structures, and non-linear payoffs require sophisticated modeling methods to estimate fair value and assess portfolio risk accurately. Another important component of Topic 5 focuses on multi-factor asset pricing models and factor investing. Candidates study the Fromer-French and Carhart models, empirical factor analysis, and the role of systematic risk factors in explaining portfolio returns. The curriculum discusses momentum, value, volatility, and liquidity factors while highlighting the challenges of factor identification, multicollinearity, and overfitting. The adaptive markets hypothesis is introduced to explain how market efficiency evolves over time as investor behavior and competition change. Candidates learn that factor returns vary across market conditions and that time-varying volatility, behavioral biases, and changing economic environments influence investment performance and portfolio construction decisions. The topic further examines directional trading strategies, behavioral finance, and digital asset valuation techniques. Candidates explore technical analysis methods such as trend following, momentum trading, divergence indicators, neural networks, and machine learning applications. Fundamental directional strategies involving macroeconomic analysis and bottom-up research are also covered. Behavioral finance concepts including anchoring, confirmation bias, loss aversion, and prospect theory explain how investor psychology contributes to pricing anomalies and market inefficiencies. Additionally, the curriculum introduces valuation approaches for digital assets, including stock-to-flow models, cost of production analysis, discounted cash flow methods, and Metcalfe's law, highlighting the challenges of valuing emerging digital investment instruments. Overall, Topic 5 Methods and Models equips candidates with advanced quantitative and analytical tools necessary for evaluating alternative investments and complex portfolio strategies. The curriculum integrates financial modeling, factor analysis, credit risk assessment, statistical techniques, behavioral finance, and derivative valuation into a comprehensive analytical framework. Candidates develop the ability to interpret multi-factor regressions, evaluate model assumptions, analyze dynamic correlations, and identify market inefficiencies across asset classes. By combining theoretical foundations with practical applications, Topic 5 prepares investment professionals to apply sophisticated modeling techniques in portfolio construction, security valuation, risk management, and investment strategy evaluation within increasingly complex global financial markets.